Did you know that nearly 75% of individual investors underperform the market? Or that overconfidence can reduce your annual returns by up to 6.5%? These are startling statistics, but they highlight a critical truth. Investing isn't just about picking the right stocks. It's about avoiding the common mistakes that derail so many portfolios. Welcome to our deep dive into the 5 rules for successful stock investing. Today, we'll uncover the top 6 mistakes that even savvy investors make. From blindly following the crowd to misjudging risk, we'll explore how these pitfalls can cost you big time. But don't worry, we're not just pointing out the problems. We'll give you actionable strategies to steer clear of these traps. Are you ready to learn how to protect your investments and boost your returns? Let's get started with the mistakes you absolutely need to avoid. Stay tuned for eye-opening insights and tips that can transform your investing journey. Chapter 1. Blindly following the herd. The folly of groupthink in investing. It's easy to get swept up in the latest investment craze. Everyone seems to be buying, so why not join in? But hold on. This is where the first major investing mistake often occurs. Blindly following the herd. Historically, such moves have led to bubbles, like the dot-com bubble of the late 1990s when investors poured money into any company with an E in its name, only to see most of those stocks plummet later. Warren Buffett, the Oracle of Omaha, famously said, "Be fearful when others are greedy, and greedy when others are fearful." This highlights the danger of groupthink in investing. When investors ignore individual analysis and follow the crowd, they often miss the red flags that signal an overvalued market. Remember, just because everyone is buying doesn't mean it's a good buy. Interestingly, research shows that herd behavior in financial markets can lead to excessive price volatility and, ultimately, to significant market corrections. According to a study by the National Bureau of Economic Research, herd behavior was a key contributor to the 2008 financial crisis. This shows the risks involved in following the crowd without a clear understanding of the market dynamics. So, what should you do instead? Start by doing your homework. Analyze the fundamentals of each investment. Look at the company's earnings, debt levels, and growth potential. Are you investing because you see real value, or are you simply following the crowd? This distinction is crucial. Chapter 2. Ignoring the financial foundations, skipping the homework. The second big mistake is ignoring the financial foundations. It's tempting to skip the detailed financial analysis and focus on the more exciting aspects of investing, like potential returns. However, this can lead to catastrophic mistakes. As noted in Pat Dorsey's book, The 5 Rules for Successful Stock Investing, understanding a company's financial health is fundamental to successful investing. For example, consider the importance of the debt-to-equity ratio, a critical indicator of a company's financial health. A high ratio might indicate that a company is at risk of defaulting on its debts, especially in an economic downturn. Surprisingly, many investors overlook these basics and focus solely on earnings or stock price trends. Another key aspect is the company's earnings quality. Are the reported profits backed by actual cash flows, or are they a result of accounting gimmicks? The collapse of Enron is a classic example of how earnings manipulation can mislead investors. Enron's downfall showed the devastating effects of ignoring the financial fundamentals, where manipulated earnings reports led to inflated stock prices that eventually plummeted. In your investing journey, make it a habit to review the financial statements of any company you consider investing in. Check the income statement, balance sheet, and cash flow statement. Look beyond the numbers. Assess the quality of earnings and the sustainability of the company's business model. Remember, the devil is often in the details. Chapter 3. The perils of overconfidence, when ego clouds judgment. Have you ever felt overly confident about an investment decision? It's a common trap that many fall into, thinking they can't possibly be wrong. This overconfidence can lead to one of the most detrimental mistakes in investing. A study by the University of California found that individual investors who traded the most, buoyed by their confidence, earned an annual return 6.5% lower than the market average. Clearly, overconfidence can be costly. It's crucial to question your investment decisions and seek advice when necessary. As John C. Bogle, founder of Vanguard Group, advises in his writings, the first step in making money is not to lose it. This means recognizing when your decisions are driven by confidence rather than reason. Are you investing or just gambling? This is a question worth pondering. Another aspect of overconfidence is ignoring external advice or data that contradicts your beliefs. Cognitive psychologists call this confirmation bias. where investors seek out information that supports their existing opinions and ignore contradicting evidence. Overcoming this bias is essential for sound investing. The strategy here is simple but powerful. Always double-check your facts, seek diverse opinions, and remain open to changing your stance. A good practice is to write down the reasons for your investment choices. Later, review these reasons to see if they still hold true. This can be an effective way to keep your overconfidence in check and make more rational decisions. Chapter 4. Misjudging risk. Playing it too safe or dangerously. Misjudging risk is another critical error that can derail your investment strategy. Many investors either play it too safe, missing out on significant growth opportunities, or they take on too much risk, exposing themselves to severe losses. Finding the right balance is key. As stated in The 5 Rules for Successful Stock Investing, understanding and managing risk is more important than seeking high returns. For instance, overly conservative investors may stick to low-yield investments like bonds or savings accounts. While these are safe, they often fail to keep up with inflation, leading to a loss of purchasing power over time. On the flip side, those who chase high returns from speculative stocks or complex financial products can face steep losses. A poignant statistic to consider is that according to a survey by Bankrate, only 28% of Americans prefer investing in the stock market, which historically yields higher returns, due to fear of risk. This illustrates a widespread misjudgment of risk that can prevent financial growth. To correct this mistake, start by understanding your own risk tolerance. Assess how much volatility you can handle without becoming anxious. Then, balance your portfolio accordingly. Use tools like diversification and asset allocation to manage the risk. Remember, diversification isn't just about owning different stocks. It's about having a variety of asset classes that react differently to market conditions. By evaluating and understanding the risks involved, you can avoid the extremes of being too cautious or overly bold. This balanced approach will help you achieve steady, long-term growth in your investments. Chapter 5. Short-term temptations. Sacrificing longevity for quick wins. It's tempting to look for quick profits in investing, but one of the gravest mistakes you can make is prioritizing short-term gains over long-term stability. This approach is akin to sprinting the first part of a marathon. It might feel good initially, but the chances of burning out are high. Pat Dorsey in The 5 Rules for Successful Stock Investing emphasizes the value of patience, noting that the most successful investors are those who play the long game. Consider the tech bubble of the early 2000s or the more recent cryptocurrency booms. Many investors jumped in hoping for quick gains, but those who didn't cash out in time faced massive losses. According to a study by the University of California, investors who focus on long-term strategies tend to outperform those chasing short-term gains by a significant margin. The key strategy here is to focus on the fundamentals. Look for companies with strong business models, good governance, and the potential to grow steadily over time. Avoid the noise of market speculations that promise quick profits. Remember, investing is not about hitting the jackpot overnight, it's about growing your wealth steadily and securely. Another useful tactic is to set clear investment goals. Are you saving for retirement, a new home, or your child's education? By knowing what you're investing for, you can better resist the temptation to cash out or flip investments for quick returns. This helps in building a more robust and purpose-driven investment portfolio. Chapter 6. Neglecting industry trends. The blind spot in sector health. Failing to consider the broader industry trends is like driving with blinders on. You might be moving forward, but you're missing out on vital signs that could indicate a turn or a stop ahead. This mistake can lead to significant losses if an entire sector starts to decline and you're too focused on individual stocks. Pat Dorsey points out that an investor's success often hinges not just on picking the right stocks, but also on understanding the health and direction of the industries those stocks are part of. For example, the decline of the print media industry was predictable with the rise of digital content, but investors holding onto newspaper stocks without acknowledging this shift faced dwindling returns. Similarly, ignoring the rapid growth of renewable energy could mean missing out on some of the most significant investment opportunities today. To mitigate this, always keep an eye on industry reports and trends. Are there new technologies emerging that could disrupt the market? What are the regulatory changes affecting the sector? Engaging with these questions can help you adjust your investment strategy in time to capitalize on new opportunities or pull back from impending risks. In practice, diversifying your portfolio across different sectors can also shield you from the downfall of any single industry. This doesn't mean having a stake in every industry but rather selecting a mix that can withstand various economic cycles. This strategic diversification ensures that you are well placed to benefit from sectorial growth while being protected from industry-specific downturns. By staying informed and proactive about industry trends, you can make smarter investment decisions that yield better long-term results. Remember, the goal is to see the big picture, not just the appealing parts of it.